Let's connect with Jyoti Vardhan Jaipuria, Head of Research with Bank of America Merrill Lynch. Jyoti, morning. Thank you for joining us. Jyoti, I just read your strategy report in the morning, and your report is explicit. It is clearly, you are clearly expressing a thought that bad could get worse for Indian markets, and for those who've not sold Indian equities, they should sell and get out.
See, Nikunj, there are lots of problems which are there. The good thing is that I think now more and more people are getting aware of the problems, because I have been saying this for the last probably 18 months now, that growth is slowing down, investments are not coming through, and there's a risk to the GDP on the downside, there's a risk to the earnings on the downside. I think 18 months back people were very skeptical about what we are saying, but now more and more people are coming into that camp. So we're starting to see that action. Like if you see the economists, most of them in the last 18 months have cut their GDP growth estimates dramatically. If you see the analysts, they've cut the earnings growth estimates dramatically. So now we have seen action which has justified that. In some sense, market has started to factor that in. So to that extent, the good thing is probably now more and more people are aware of the problem. It's the same things which we've been saying for 18 months, which now have made people, nervous on India.
So, Jyoti, how do you think the central bank is going to go about tackling the issue of slowing growth as well as high inflation? And do you think then that makes the base case stronger for a rate cut come June 18th?
Yeah, my view is that at some point RBI has been trying to do this balancing between growth and inflation. Their view till some time ago was, inflation is the bigger fear, growth is coming along and growth is not getting disturbed. I think now the numbers as they are coming out, probably what they are going to start feeling is that growth is getting as much of a concern as inflation. What may help India is if we can see global commodity prices come down, like, oil has come down, but unfortunately the rupee depreciated, so we're not getting the full benefit. But globally, if things start to ease off a bit, then, it will give them even more ammunition, because probably inflation then will appear to be peaking out, growth will become the bigger concern for them, and it will give them more leeway to cut rate. My call is that personally I think, rates will probably get cut more than what the consensus is expecting today.
So Jyoti, for FY13 then, what is your bear case scenario, because you hardly have a bull case scenario?
Okay, so like if you think of markets, let's keep market and economy separate, because I think the economy will still be under pressure, and whatever gets done works with a time lag. So even if we see rate cuts, even if we see, reforms happening, it probably takes some time for that to translate into GDP numbers and economic numbers. But if we think of the market, then, there are a lot of negative news on economy, earnings, things are going to be slow. At the same time, if we can get, rate cuts which are quite sharp, or they are at least more than what the consensus estimates, and the government does a bit of reforms, because at the moment expectations are low, then that could really be the bull case for market. What we have to remember is most people now are probably underweight India. People have given up on India. The news on India is quite negative, so you don't need much to take the market up also maybe. The positive surprise could be a bit of reform, which maybe 2 years back people would have ignored, but today they'll say, okay, things are changing in India, we must have a look at it.
Jyoti, can I challenge you on that? When you say global fund managers are underweight on India, let me share official data which is available on SEBI's website. This year, foreign institutional investors have pumped in about $8 billion, which is some kind of a record inflow. Why do you think global investors are underweight on India?
It's like, if we look year to date, and there are lots of things which have gone wrong in India, but year to date up to March, this is the highest amount of FII flows we've had in the first 5 months of any calendar year. So it's a bit of paradox where, probably 2012 in the first 5 months has seen the highest FII flow which has come into India. At the same time, everybody says that they've sold India, they've been underweight. Now, what we track is, some data which we have on what is the weighting of fund managers in all countries. And what we've seen is generally the weighting has come down. So people are very marginally underweight India to neutral India at the moment, in spite of the flows which have come, because flows have also gone to other emerging markets. But what has also helped India probably is two things. One is ETF flows have come in, which probably didn't get into the benchmark. Second is we've seen flows come in from sovereign wealth funds, which again does not get into the benchmark. So that's the reason, you got flows. At the same time, a lot of people say they are underweight India.
Jyoti, how crucial is the date of June 17th when we are going to see the Greece election outcome for markets like ours?
See, that's a global overhang. There are actually lots of global overhang today which will weigh on the market also. Greece and the Eurozone is obviously one of them. What we'll also have is probably, the US and how the economy shapes up. I would say that, that Europe overhang is something which probably is a big threat to us. It's a big threat to markets globally. In the worst case outcome, if we see, Greece walk out of the Eurozone and we have like a total blow up over there, then we could see, risk appetite just come down a lot, and India generally does not do well when there's risk aversion globally. It would probably help the economy in some perverse way, because what it will lead to is probably a fall in global commodity prices. So for RBI, a lot of this inflationary pressure may be seen to be easing off. But otherwise, it probably would be the one negative for the market which is there at the moment.
Jyoti, if a client walks up to you and if his thought process is that, look, I'm ready to digest a 10% or 15% near-term volatility, but give me some ideas, which could be 2x, 3x, even 5x next 3 to 5 years. How would you address this query? How would you address this question?
Yeah, a lot of people do buy, like we have a lot of institutional investors who want to buy the dip, to look at valuations and who say, okay, India is starting to look a bit cheap, and somewhere we have faith that the government is not doing reforms now, but beyond a point, reforms will happen, and there's a natural momentum to growth. Like what you have to remember is, in spite of all the problems we've had, the economy is still grown at its worst case. Even if we take the last quarter GDP number, is grown at over 5%. So there's a bit of momentum which is there, because 5 probably still places India in the top 3 fastest growing countries in the world. So that's why we have people who do want to buy every dip, who want to buy for the longer term. And a couple of things which we always focus on is, one is consumption, which everybody agrees with, that yeah, there are consumption stories in India which look good, because there's just the demographics which will continue to lead to a big surge in consumption. Over there, what we generally push now is not the staples as much, because they're looking quite pricey. But the auto sector is something which we like, especially because we think rates will come off a bit. And penetration is reasonably low. We think a lot of people will want to buy cars, will want to buy two-wheelers. So that's one segment which we really push in a big way. There are some people now who are willing to buy the infrastructure story, because there's been a whole lot of bad news on these sectors, and the stocks here in the sector are low compared to where they were at the peak 2-3 years ago, when they were looking very pricey. So if infrastructure takes off, some of these stocks could give you decent returns over the next 3 to 5 years. So these are two broad segments which really we push, and people are interested in buying.
So Jyoti, what is your estimate at Bank of America Merrill Lynch? How steep could be the rate cut this time around, or do you think the RBI is going to tread with baby steps and take a 25 bips cut this time?
For us, like if we take a little 6-month, 8-month view, our view is that RBI will cut rates by another 100 basis points up to March of 2013, which is this fiscal year. So basically, we were calling for the 150 basis point rate cut during fiscal year 13. Our view was that they probably may not cut in this month, but I guess the last GDP numbers changed that, so possibly we could see a 25 basis point rate cut coming this month. But it's not just whether it's this month or not, it is whether we are entering a series of rate cuts, and we get like quite a few rate cuts happening over the next 6-9 months, which is probably more important to the market than just whether we get a rate cut coming in this month or not. Here, the RBI policy is actually on the day after the Greece election, so it will be very interesting, because they may have to weigh that also finally in their decision.
So, Jyoti, at Bank of America Merrill Lynch, what is your big contra call where you are advising your clients to allocate disproportionate amount of money?
See, for people who are looking over the next 6-9 months, we've been generally very defensive in our portfolio. We've been pushing things like the pharma, which is a play on really growth happening in spite of where the global economy, the Indian economy is going. And the second reason has been, we have been concerned on the rupee, and our call was the rupee would keep depreciating. So pharma has been one of our biggest allocations. But what we've been telling people now is probably the next 6-9 months, the money to be made and where you could get your surprise is by buying the rate sensitives, where we are really pushing two sectors. One is the autos and the banks.
Why
so these are two
autos
sectors
now,
which we have been quite bullish on.
Jyoti, why autos now? Because for auto companies, base effect has already kicked in. Competition has intensified. And at a time when inflation is high, it will only hit consumer or discretionary spending.
Yeah, so that's the whole consensus in the market. That's what everybody believes. But if you get into history, and if you look at every time there have been a series of rate cuts in India, the sector which has done very well on a consistent basis has been the auto sector. Because if you get like 150 basis point rate cut over the next 6 to 9 months, what you'll get is the fact that people start believing at least that the car demand will pick up, discretionaries will pick up. So that's the reason we are really pushing the auto sector. Like you said, you wanted what's our contrarian calls. So this is one of the big contrarian calls where we are quite convinced.
Is there merit in buying PSU banks? The world wants to own private banks, but nobody likes PSU banks. They are beaten down. Nobody likes them. They're getting treated like stepchilds.
Yeah, so if we come to the PSU banks again, there's going to be a lot of bad news on the PSU banks in the sense that we'll have more and more of loans turning into NPLs. At the same time, a lot of that is then price. Again, if we go into history, if we have a series of rate cuts, generally the PSU banks tend to do well in terms of the stock price. They may not, So what you'll have is negative news flow coming through for these PSU banks in terms of the NPLs, in terms of a lot of loan restructuring will happen. But at the same time, what you'll have is, because of the rate cuts and because of a possible belief of the market that the economy will start getting better, PSU banks will do well, especially, at these valuations which you're buying them. My view is that probably the downside is very limited. And so it is more like, do you get the upside or do you not get the upside over the next 6-9 months, which, investor has to play for.